Let me tell you about December 17th, 2025. On that single day, a group of Wall Street insiders woke up, went to work, and walked away with gains of 40% on their investment. Not 40% over a year, not 40% over a decade. 40% in a single trading day. And the company that made it happen was not an AI startup. It was not a cryptocurrency. It was not some speculative tech bet on the future. It was a company that makes surgical gloves. I am James Caldwell, and today I am going to show you exactly how Wall Street's oldest game works, why you were never invited to play, and what you can do to make sure you never miss an opportunity like this again. Here is what actually happened. A medical supply company called Medline surged more than 40% in its hotly anticipated New York debut, valuing the company at $54 billion in the largest U.S. initial public offering since Rivian's 2021 listing. Uncoa Marketing, $54 billion. Let that sink in for a moment. This is a company founded in 1966 by two brothers in Illinois, a company that makes surgical gloves, hospital gowns, and medical kits. Products that cost pennies. Products that have been quietly keeping American hospitals running for nearly 60 years. Not sexy, not exciting, not the kind of thing that gets covered on finance influencer channels. And yet, on a single Wednesday in December, Medline stock rose 40% to close at $40.66 as investors warmly greeted the year's biggest IPO YouTube. So who got rich? Not you, not me, not the average American sitting at home checking their 401k. Private equity giants. Blackstone, Carlyle, and Hellman and Friedman had taken a majority stake in the company in 2021, valuing it at $30 billion. Uncoa Marketing. They bought it for $30 billion. They sold pieces of it to the public for $54 billion, and on day one, the stock jumped another 40% on top of that. This is not investing. This is a machine. And it is a machine that has been running for decades, specifically designed to make sure the gains flow upward, while regular Americans are handed the bill. Now let me explain exactly how this machine works, because once you understand it, you will never look at an IPO the same way again. When a private equity firm buys a company, they are not buying it because they love the business. They are buying it because they see a gap between what the company is worth right now and what they can convince the public to pay for it later. Medline's upsized IPO sold more than 216 million shares set at $29 apiece, far more shares than its previous pitch of 179 million. Outlier kit. Notice that phrase, upsized. They originally planned to sell 179 million shares. Then they saw how hungry investors were and quietly increased it to 216 million. More shares, more money flowing to the private equity firms, more dilution for the public buyers. The IPO was more than 10 times oversubscribed according to Bloomberg. Flux note. 10 times oversubscribed. That means for every one share available, there were 10 institutional investors fighting to buy it. And here's the question you should be asking right now. If it was 10 times oversubscribed, why did nobody call you? Why did your broker not send you an email? Why did your financial advisor not pick up the phone? Why did the news channels not run a special segment telling everyday Americans, hey, this is the biggest IPO of the year. Here's how to get in? The answer is simple, and it is the same answer behind almost every financial opportunity that the wealthy access and the regular Americans do not. You were not the target customer. The IPO system in America was not designed for retail investors. It was designed for institutional investors, for pension funds, for hedge funds, for family offices managing hundreds of millions of dollars. When an investment bank like Goldman Sachs or Morgan Stanley manages an IPO, they allocate the shares to their best clients first, their biggest clients, the ones who generate the most fees. By the time the stock opens to the public on the trading floor, The institutions have already been allocated their shares at the IPO price of $29. When you and I try to buy it, we are buying at $35 or $37 or $40. We are buying what the institutions are selling. Let me say that again, because it is important. When retail investors rush in to buy a hot IPO on day one, they're often buying the shares that the institutional investors, who got in at $29, are now selling for a profit. The game was over before you even knew it started. Now here is where it gets even more interesting and more frustrating. Medline had reportedly considered heading to Wall Street earlier, but paused its plans following the import tariffs handed down by the Trump administration, outlining tariff costs of between $325 million and $375 million for the 2025 fiscal year. Outlier kit. Read that carefully. The tariffs cost Medline hundreds of millions of dollars. So what did they do? They went public. They passed the cost of those tariffs directly to the public investors who bought their stock. They raised $6.26 billion from everyday investors and institutions, which conveniently covered their tariff exposure, and left the original private equity owners with billions in profit. This is not a conspiracy theory. This is a publicly filed document. This is in their SEC prospectus. They told you exactly what they were doing. You just were not reading it. But here's what I actually want you to take from this video. Because I did not come here just to make you angry. I came here to make you smarter. Senior analyst Jeff Zell told Reuters that Medline is hot right now because it is profitable and generates actual cash. Omarosa. Profitable. Generates actual cash. In a world of AI hype and future promises, Medline is a real business with real revenue and real earnings, and that is exactly what smart long-term investors look for. For investors today, Medline offers public market exposure at a share price of $48.18, with the stock up 7.4% over the past 30 days and 18.6% year-to-date. Outlier kit. So the question is no longer whether you should have bought at $29. That ship has sailed. The question is, what do you do now? And more importantly, what do you do the next time an opportunity like this appears? Here are the 5 things every American needs to know about IPOs and how to never be left out again. Number 1. Stop chasing IPO day one prices. The institutional investors already made their money. Buying on day one puts you in competition with people who have been positioned for months. If you believe in the company, wait 90 days. Let the initial excitement die down. Let the lockup period end. The stock almost always gives you a better entry price 90 days after IPO than it did on day one. Number 2. Open a brokerage account that gives you IPO access. Platforms like Fidelity and Charles Schwab now offer retail investors access to select IPOs before they open to the public. You will not always get the full allocation you want, but you will get something, and something at the IPO price is far better than nothing at the day one premium. Number 3. Watch the oversubscription number. When an IPO is 10 times oversubscribed, that is a signal that institutional demand is overwhelming supply. High oversubscription plus a profitable business with real cash flow equals a strong likelihood of a day one pop. That combination is rare. When you see it, pay attention. Flux note. Number 4. Read the SEC prospectus, not the whole thing, just 2 sections, the risk factors section, which tells you exactly what could go wrong, and the use of proceeds section, which tells you what they are doing with your money. If the use of proceeds says paying down debt, be cautious. That means the private equity owners are using your investment dollars to pay off loans they took out to buy the company. You are literally paying their debt. Number 5. Understand that not all IPOs are created equal. Major AI players like OpenAI and Anthropic are also expected to explore going public within the next 18 months. Those IPOs will be 50 times oversubscribed, the hype will be deafening, and the retail investor who buys on day one will almost certainly overpay. The boring, profitable company nobody is talking about is almost always the better investment than the exciting one everyone is rushing into. YouTube. Let me leave you with this. Medline is an old-school IPO driven by fundamentals, not future promises. The company was founded in 1966 by brothers John and Jim Mills and makes and distributes critical medical supplies offering 335,000 products. MediaCube, 335,000 products. Surgical gloves, hospital gowns, medical kits. Not a single line of code, not a single AI algorithm, not a single promise about the future. Just a real business, making real things, that real hospitals need every single day. And that boring, unglamorous, completely unsexy business made 40% in a single day for the people who knew about it. The lesson is not that you missed Medline. The lesson is that the next Medline is already out there, already being prepared, already being positioned, and the institutions are already allocated. Your job is to be ready, to know how the game works, to stop waiting for your broker or your financial advisor or CNBC to tell you what to do. Because by the time they tell you, the money has already been made.
Thanks for watching. See you next time.